What's up, everyone, and welcome back to the Loose Ventures channel. I made a video summarizing my approach to value investing. It's a shorter video, and I boiled down my approach to 4 crucial steps that I follow for every equity analysis and valuation. So hopefully this helps. I'll be abiding by these steps going forward for every video that I make on every stock that I analyze. That said, let's get right into it. So, 4 steps. First step is financials analysis. This is going to be the meat of the whole presentation. Second step would be risks, very important as well. Third step would be valuation, which is multiples based. And the fourth step would be trade ideas to help you come up with your own strategy for how to trade any particular stock. Number 1, financials analysis. Always start with estimates because you always need to be forward looking. I always focus on revenue growth as well as earnings. So a good example here would be Stellantis, a electric vehicle auto manufacturer that is also making legacy gas-powered cars as well. Still a good part of the business. And here I can see their estimates. I can see revenue right here. I can see how many estimates they have for revenue. I can look at EBITDA, and I can also look at free cash flow. Those are the main metrics I'm going to focus on, and I want to look out about a year to 2 years for each of those metrics. I'm going to do the same thing for every other stock. So you can check that on ticker.com, as you can see right here. Another thing I want to take note of is what's the potential for the stock to be a value trap. So those estimates will tell me if analysts are expecting revenue or earnings to drop dramatically. If that's the case, could be a value trap, too good to be true. Profitability. I want to look at operating margins. I want to look at historical consistency in those operating margins. So a good example here would be Meta, a company that everyone hates. Let's look at operating income. This is ROIC.ai is the website. And here I can go all the way back to right here. It's showing back to 2010. And I might look for some red flags, like periods of times when operating income went negative. Maybe all of a sudden it's positive. I need some consistency in historical margins so that I can trust forward projections. If that consistency isn't there, then maybe it's time to look at another stock. Another metric of profitability, EBITDA, earnings before interest, taxes, depreciation, and amortization. This is a proxy for earnings and a measure used as an industry standard in valuation. Lastly, we'll look at free cash flow, which to me is the most important. That's just cash from operations less capital expenditures. This is unadjusted hard cash earnings. No non-cash adjustments being included in free cash flow. So EBITDA and free cash flow are going to drive my valuation, and those are the metrics I'm going to focus on when comparing this stock or whatever stock I'm looking at to its peers and deciding when it's time to buy the stock. Continuing with financials analysis, liquidity, spot check on the balance sheet, current ratio. I want that to be above 1. Current ratio is just your current assets divided by current liabilities. This is a general spot check. It's not always going to be above 1. Doesn't always mean the company's in bad shape. Again, I just want to check liquidity real quick. Sometimes it requires a deeper dive. Excess cash can be good. Cash, by the way, is a current asset. But watch out for SPACs, IPOs, and potential value traps that are hoarding cash and don't know what to do with it and are burning that cash in the meantime because they can't figure out how to be profitable or their profitability is dropping dramatically or expected to drop dramatically going forward. Leverage, debt to EBITDA. I want that to be below 3 times. I'm going to compare EBITDA or the earnings to the total debt load on the balance sheet. Sometimes a deep dive is required, especially for those deep value plays, because the structure of a company's debt can be complicated. That's going to be on a case-by-case basis, but just for starters, I want it to be under 3 times. That's a bit of an industry standard. Overall, I just want to make sure the company can cover their debt obligations over a certain period of time, given their earnings power. Lastly, I want to look at share issuance and repurchases. I don't want to invest in a company that's issuing more than 5% of revenue as stock-based compensation. That stock-based comp can turn into dollar expenses. And if they're not repurchasing the shares that they're issuing, it's just diluting the shareholders year over year. So it either equates to dilution or they're using the company's own cash flow to repurchase the shares that they're issuing to themselves. That's a no-go for me. I don't put up with it. Neither should you. Number 2, risks. First risk, cyclical. Look at supply and demand. Look at historical and expected economic trends. Semiconductors. Maybe the supply and demand chain normalizes. Marine shippers. Maybe freight rates drop, right? So you have to consider cyclicality. That's a big risk for a lot of these stocks, and it could highlight some potential value traps. Always look at supply and demand on a forward basis. And a lot of times you could just zoom out in the price chart. So when in doubt, zoom out. Price chart tells you a lot. Dilution. Companies will dilute for a number of reasons, sometimes for acquisitions, but just because an acquisition is making a company more money, it doesn't justify significant dilution most of the time. Sometimes this is the case, most of the time it isn't. So watch out for companies that dilute shareholders on an annual basis because they're just devaluing your shares year over year. That's a big red flag to me if they're doing too much of it. Last risk, management, perhaps the biggest risk sometimes. I just do a basic check because financials should reflect management ability. Again, we want to look at consistency of the company's performance over the long term, right? Over at least the past 3 years. Insider transactions can be a good indicator. This is important for deep value plays as well. Companies buying or management buying shares at a nice low price gives a bit of faith to the shareholder waiting to make good returns. New companies are an automatic no-go. No performance, sorry, I'm not buying the stock, and maybe it's best for most other people to stay away from those new companies anyway. Number 3, valuation. Projected multiples because nobody cares about your discounted cash flow model. The markets don't care about price targets. That's not how stocks work. And I typically look 1 to 2 years out. Again, I want that debt to EBITDA to be below 3 times. We're talking about forward, so what they're going to make in EBITDA. And I'm also going to look at enterprise value to EBITDA and free cash flow divided by enterprise value. Enterprise value is simply the market cap, less cash, and then add back or add debt. I'm going to look at those primarily. Sometimes I'm going to look at price to book value. Maybe it's a deep value play, a cigar butt play, something like that. I'm going to try to find companies trading at the low end of that historical trading range and compare that company to its peers. So a good example would be Nintendo. Here I have the past 5 years pulled up for the range that they've been trading at. So you can see enterprise value to EBITDA here, and you can see free cash flow yield right here. So that's ticker.com. And by the way, ticker.com and ROIC.AI are free. That's why I'm mentioning them. And I'll put links down in the description below. Lastly, I want to apply a margin of safety. I want to count for risk, and I need to sensitize those projections if I think it's necessary. You don't have to use margin of safety, but it's important to apply some kind of risk metric to your analysis just in case your thesis does not prove to be correct. Margin of safety is easy. You just apply a percentage discount to the current price that the stock is trading at, or you say, I want to buy a 20% discount to what I think is a good value, right? So this is just another way of being conservative with buying stocks and adding to current positions. Have some kind of risk metric in your analysis. Be conservative. Don't get FOMO. Lastly, number 4, trade ideas. Choose a strategy based on your thesis and time horizon, not mine, and decide on the most effective trade that you're comfortable with. Is the stock paying a dividend? Maybe it makes sense just to load up on shares, right? Maybe you don't want to put up too much capital and you want to add some leverage. Options, maybe long-term options could be a very good play, especially if there's an event coming up that you're trying to trade. How about dollar cost averaging? Prevents FOMO, and it's a strategy that's as effective as it is underrated. Don't knock dollar cost averaging. Don't think it's only for the old guys, the boomers, the fossils. Everyone should use dollar cost averaging to some degree if you're, say, investing for retirement, whatever the case is, it's your part-time job investing, whatever it is, dollar cost averaging is a great strategy. That's it. So 4 main points to cover. 1, financials analysis. 2, risks. 3, valuation. And 4, trade ideas. So from here on out, that's how we're going to look at every stock. That's how I'm going to walk through every analysis and valuation going forward. So that said, thanks for tuning in. I'll see you in the next video. Cheers.